Hi, I'm Mavry Davis. In this video, I'm going to cover all the basics of how to prepare financial statements. Now, for most introductory financial accounting courses, this is a common learning objective. The best way to understand how to read and interpret financial statements begins with understanding how they are prepared. There are four basic financial statements. The first rule you need to know is that financial statements must be prepared in order. That means the income statement must be prepared first. Why? Because information from one statement is used on the following statement. The end result on the income statement is net income, and that is used in preparing the statement of stockholders' equity. This is sometimes called the statement of changes in equity. If you were a sole proprietorship or a partnership, the statement's title would simply be called the Statement of Owner's Equity. Whichever type of business, this statement is summarizing the results of what has occurred related to equity and the entity's ownership for the current period. The third financial statement is the balance sheet. The ending balance of the equity from the statement of stockholders' equity are the balances reported on the balance sheet. The fourth and final statement is the statement of cash flows. To prepare this statement, you need the other three statements along with some other data. The next basic rule for preparing financial statements is how to label your statements. The heading of each statement should consist of three lines: name of company, name of statement, and something to do with the date. I always tell my students to remember back to elementary school. When you were first learning how to turn in your homework assignments, the first thing you always put on your paper was your name. The second line is the name of the statement. You are simply labeling what statement this report represents. This is especially important for introductory accounting students, as you are just becoming familiar with these four statements. The third is the tricky part: something to do with the date. Three of the statements follow the same dating methodology for the period ending. So if you were presenting the financial statements for the most recent quarter that ended on September 30th, the date line would read for the quarter ended September 30th. Or if you were presenting the financial statements for the most recent year ended on December 31st, the date line would read for the year ended December 31st. That's right. The statements cover a range of dates. The balance sheet is different. The date on the balance sheet is simply the last date of the period. Using our previous examples, the date line on the balance sheet would simply read September 30th or December 31st. This is because the balance sheet represents the balances on this particular date, not the balances for the range of that entire period. Some people say the balance sheet is like a snapshot. If you took a picture of all of the accounts, those are the balances on this particular date. Now, let's go over these financial statements in more detail. We'll start with the first statement, the income statement. This statement summarizes the revenues and expenses for the period. How well did we perform in terms of profitability for the recent period? That is the most important question that is answered using the income statement. The income statement measures our financial performance of profitability. When comparing revenues and expenses, we of course hope that revenues are more than our expenses. Revenues less expenses is referred to as net income. Now, this is a phrase where outside of accounting, you may have thought of calling it something else, but our accounting term for the difference between revenues and expenses is net income. If revenues are less than expenses, That is not good. In this situation, we call the difference a net loss. The company is losing money if expenses are more than revenues. Now, if we could stop here, this income statement would be pretty easy. This simple revenues less expenses format is referred to as the single step income statement. But you are preparing to become a CPA, so we're not done. To better provide information to the users, which is the entire purpose of these financial statements, we will present the income statement in a certain format which groups the results into multiple levels of income. We'll go through the process on the next few slides together. What is the first thing on the income statement? Sales revenue. That is always the first line of your income statement. But total sales revenue needs items subtracted to arrive at the net sales revenue. Two common items that a business may have are sales returns and allowances and sales discounts. Sales returns represent the return of an item previously sold. Allowances would not be the return of an item, but rather given a reduction to the sales price after the sale. Sales discounts are discounts we offer to our customers to pay more quickly. All of these items are tracked separately in their own accounts in order for clarity and more useful information for business decisions. For example, let's say we noticed that one particular store had 3 times as many sales returns as other stores. Management would want to investigate or look into the policies and practices at that store more closely. Is there an overly aggressive salesperson at that store? Are they making errors or is there possible fraud? Clearly, understanding financial statements will help identify potential problems to look into. Since we track these items in separate accounts, we need to subtract them from the sales revenue to arrive at the net sales revenue. Now that we have the net sales revenue, the next line is the subtraction of the cost of goods sold. I always love explaining cost of goods sold to my students, as the title explains exactly what is recorded in the account. The cost of goods sold. The difference between the net sales revenue and the cost of goods sold is referred to in the accounting world as the gross profit. Another term that means the same thing is gross margin. Just in case you see that term on the CPA exam, don't get it confused between the two. Gross profit is the first level of profit shown on the multi step income statement. The gross profit is the profitability from the company's main activity, selling the goods. Some of you may think of markup when you try to remember or understand gross profit. Next, you subtract the operating expenses. These are the expenses from operating the primary activities of the business. Operating expenses are often called the selling, general, and administrative expenses. There are a lot of expenses that will be included here, such as rent, utilities, salaries, and advertising. This arrives at our next level of profit called operating income. Sometimes you will see this line called income from operations. This is how profitable the company is from its main or primary business activity. This is also where my students try to stop. They sometimes think that they are done, but operating income is not the same as net income. There are some more expenses that need to be subtracted. So let's go to our next slide to finish. Now, here is all the rest of the income statement that we still need to cover. After operating income, we address the other stuff, the other revenues and other expenses that are not related to the primary operation but are still recorded by the company. Let's say we operate a grocery store. If we sell the empty lot behind our store and record a gain on the sale of land, that's an example of an other item that would be found here. Are we in the business of buying and selling land? No, we're a grocery store. We sell potatoes. Investment related activity such as gains or losses on the sale of stocks and bonds or dividends received on those investments, those would also be good examples of other types of activities reported here on the income statement. Please realize that not all companies have these items. The other revenues and gains would be added to the operating income. Other expenses and losses would be subtracted from the operating income. Now we have our next level of profitability, income before income taxes. Income tax expense is a significant expense and is shown separately before arriving at the net income. That's it. This net income is the same amount we would have calculated if we simply took revenues less expenses. But in presenting these multiple levels of profitability, this income statement format provides better information for the financial statement users. The second statement prepared is the statement of stockholders' equity. This statement is also referred to as the statement of changes in equity. I do like that name as it describes how to set up this statement. You are simply presenting all of the increases and decreases in equity. Traditionally, this statement will have a column for each account or type of equity. At a minimum, for a corporation, you would see a column for common stock and a column for retained earnings. And then the last column would be a total column. Other columns you might have, depending on the company and its transactions, would be preferred stock, additional paid in capital, and treasury stock. The first row of the statement would be the beginning of the period, which is January 1st for a calendar year report. This is called the beginning balance. Then you have a row for each change in equity. Let's say that during the year, the company issued $10,000 of common stock. The row would say issuance of common stock, and then you would see the $10,000 added in the column under common stock. If the company declared a $4,000 dividend, you would see a row labeled as dividends and find the corresponding $4,000 reduction under the retained earnings column. And of course, don't forget about net income. Remember that we found net income on the income statement. That amount now carries forward to the statement of stockholders' equity. Net income would be a row, and that dollar amount of net income would be added under the retained earnings column. The end result is that this statement will show the year end balances of each component of stockholders' equity on the last row, December 31st, for a calendar year company. The ending balances here are the balances that are reported on the next financial statement, the balance sheet. This is a good time to review how to calculate the ending balance of retained earnings. The formula is beginning retained earnings plus net income minus dividends. That will arrive at the ending retained earnings balance if revenues are less than expenses and the company has a net loss. The net loss is subtracted. The third financial statement is the balance sheet. The thing about the balance sheet that a lot of students like is that it has to balance. This statement summarizes the basic accounting equation of assets equals liabilities plus stockholders' equity. If your balance sheet doesn't balance, then you know you've made a mistake. Now, just so that the CPA exam doesn't trip you up, this balance sheet can also be referred to as a statement of financial position. Beyond the basic accounting equation, we can classify the balance sheet to provide more detailed information for the financial statement users. Assets can be further classified into groups called current assets, investments, property, plant, and equipment, and then other assets. Current assets are those assets that provide benefit within the next year. Common examples are cash, accounts receivable, prepaid expenses, and inventory. The other groups or classes of assets are long term assets. These assets provide benefit for more than 1 year. Investments include investments in debt and equity security, property, plant, and equipment, often referred to as PPE, includes land, buildings, and equipment. Other assets is the category which is used to capture other types of assets, such as intangible assets, goodwill, trademarks, and the like. Liabilities are split into two groups, current and long term. Similar to assets, the accounting definition of current is within 1 year. Current liabilities are debts or amounts owed that are due within the next year. Long term liabilities are due in more than 1 year. The last category is stockholders' equity. The great news is that it is going to be the easiest section to prepare since you already did the statement of stockholders' equity. This section includes all the ending balances from that previous statement. The fourth and final financial statement is the statement of cash flows. This statement summarizes the company's cash inflows and outflows for the period. These inflows and outflows are grouped into one of three business activities: operating activities, investing activities, and financing activities. This statement of cash flows is the most difficult statement to prepare. In fact, we have another video lecture where we walk you through the whole process of preparing this statement step by step. So if you need to review the details of this statement, check out our other Gleim video on the topic. The best way to prepare for the CPA exam is to do it. Let's look at a comprehensive example that will test your understanding. Hugh Company reports the following balances at the end of year 2017 on its trial balance. Here you can see a list of all their accounts. The company issued $40,000 of common stock during 2017. Okay, notice how these are the balances on the trial balance. The trial balance is a listing of all the accounts and their balances at the end of the year. The trial balance is the source of where all the numbers come from that you use to prepare the financial statements. The other key item I want to point out is the retained earnings balance. The number you see here on the trial balance is actually the beginning of the year balance for retained earnings. The balance won't be updated until the period's closing entries are recorded. Then it will reflect the ending balance of retained earnings. If you need to refresh on the accounting cycle and the process of preparing a trial balance and closing entries, study our video on that topic. The last item is a note so that we have enough data to prepare the statement of stockholders' equity. If the company issued $40,000 of common stock during 2017 and the ending balance is now $250,000, then what did the beginning balance of common stock have to be at the start of this year? Yes, you got it, $210,000. Could you use this jumbled up list of accounts and balances to prepare financial statements? That is what we're going to do now. Which financial statement must come first? The income statement. The heading for the income statement is the name of the company, the name of the statement, and then the third row shows that these are the results for the year ended December 31st, 2017. The income statement starts with net sales revenue, then we subtract the cost of goods sold to find the gross profit of $106,300. This is the first line or level of profitability reported on the multi step income statement. Next, we subtract the operating expenses, which are administrative and selling expenses. The company's operating income is $52,500. After operating income, any other gains or losses or investments, revenues, or expenses are reported. The only item we have here in this example is interest expense of 7,000. Operating income less interest expense is the company's income before income taxes, 45,500. The last expense subtracted is the income tax expense of $13,650. The company's net income for the year ended December 31st, 2017 is $31,850. Now, remember that answer is going to be used on the next statement, the statement of stockholders' equity. Here is the statement of stockholders' equity for the year ended December 31st, 2017. This company has two components of stockholders' equity, common stock and retained earnings. Each column summarizes the activity for the account for the year. The column for the retained earnings follows the formula we talked about for retained earnings. The beginning balance plus net income and less dividends. Dividends is an account that introductory students often forget where to put when they are preparing financial statements. So highlight dividends or make a note so you don't forget. This statement of stockholders' equity is the proper place to report dividends. The ending balance for common stock is $250,000, which is the same as found on the trial balance. Remember, we had to figure out that if $40,000 were issued during the year, the beginning balance must have been $210,000. For retained earnings, though, this is now the updated ending balance for December 31st, 2017. This $84,650 is the balance for retained earnings that must go on the next financial statement, the balance sheet. I must admit, this is the most common mistake my students make on their exam when I ask them to prepare a balance sheet. Many of them would use the $62,800 figure from the trial balance, but that is the beginning retained earnings. Luckily, my students know that the balance sheet we are about to prepare must balance. So, if you make the mistake of trying to use the $62,800 beginning balance, you will quickly realize that you have made a mistake because your balance sheet won't balance. So, again, I will repeat this since it is so important. The ending balance of retained earnings shown here, 84,650, is the balance for retained earnings reported on the balance sheet at year end. Let's start with the heading on the balance sheet. Remember, these are the balances reported at a specific point in time, December 31st, 2017. So the date just says December 31st, 2017. For the assets, you need to make sure you classify them into the correct group. Current assets that Hugh Company reported on their trial balance were cash and inventory. So the total current assets are $118,600. The only other category of assets that the company has is property, plant, and equipment. We abbreviated that as PPE on this slide. The net amount for the buildings, net of accumulated depreciation, is $340,000. You add together the total current assets and total PPE to arrive at the total assets of $458,600. Okay, we are halfway done. Now to the other half of the accounting equation. Remember, assets must equal liabilities plus stockholders' equity. For liabilities, we must distinguish between current liabilities and long term liabilities for the classified balance sheet. The current liabilities is the accounts payable. Accounts payable usually consist of short term amounts due to creditors such as 30, 60, or 90 days. In our list on the trial balance, it was noted that the notes payable is due in 2020. That is more than 1 year from the balance sheet. So this notes payable would be classified as a long term liability. Current liabilities and long term liabilities are added together to arrive at the total liabilities of $123,950. The last section is stockholders' equity. We use those ending balances from the statement of stockholders' equity here for common stock and retained earnings. Remember, make sure you get the ending balance of retained earnings, $84,650 from the statement. Total stockholders' equity is then $334,650. The last line on the right hand side is to add the liabilities and stockholders' equity together to get $458,600. And your last step is to make sure that the total amount of assets is equal to the total amount of liabilities and stockholders' equity. We have $458,600 for both. So, good news, our balance sheet is in balance. I know this was a long example, but I really think working through these statements together can help you understand the concepts. That's it for the financial statements lecture. Be sure to check out our deep dive topic video on the statement of cash flows. Remember, these statements are the way a business communicates its results and performance to users. Users could be investors, creditors, regulators, customers, or employees. The income statement reports profitability and the company's net income. The statement of stockholders' equity shows the changes in each component of equity from the beginning of the year to the end of the year. The balance sheet shows the balances of the assets, liabilities, and stockholders' equity at the end of the period. The statement of cash flows reports the cash inflows and cash outflows of the business. I hope you remember this lesson and that it helps you when the CPA exam asks you about financial statements.